I'm joined by two important guests today, Sanjiv Puri and Mr. Rajan Navani. Welcome to NDTV Profit, sir. I'd like to start with you, Mr. Puri. What's your take on the budget overall, and do you think that it will set a tone for Viksit Bharat, which government is aiming at 2047?
It's a very good, in fact, very fine budget. It's a very good, very fine budget with very clear focus on inclusive and sustainable growth. It's also very sharply focused on reforms. At the same time, maintains the fiscal prudence. And just to call out some very important facets of this budget. Firstly, there's a lot of impetus or focus being provided to sectors that have high labor intensity. You know, agriculture, MSMEs, within that toys and footwear, and then tourism, and you look at the exports focus, and this whole idea to create an institutional mechanism for an integrated view on exports, which is very much required to develop it sectorally, like we've succeeded in the remarkable successes in electronics, for example, mobiles. And how do we take the lessons and provide impetus to some other sectors? I think then there's a very strong focus on human capital development, very strong focus on innovation in infrastructure, and at the same time, a lot of very clear messages on reform. Collaboration with the states, incentivizing states, because a lot of reforms have to happen at the state, setting up the high-level committee to create the vision. I think these are great ideas. And also the budget provides impetus to consumption by relief provided to the middle class on income tax, I think the social security to the gig workers. Of course, all the other employment generating activity and productivity in agriculture in itself will also feed into employment and therefore consumption. But these are things that are likely to impact in a much shorter span of time.
Yeah, to summarize, they touched upon all these sectors, you know. So, coming to you, Mr. Raval, I wanted to understand from you that how you seeing these, decisions, particularly in the, manufacturing sector as well as infrastructure sector. Do you think those measures are kind of, help these sectors to sort of grow further, because we have seen decline in the current fiscal year? What's your take on that?
No, I think, the core spirit, right, if we are looking at a 25-year-old growth plan for a country, is for all of us to be aligned together. I think, the fact that the finance minister, mentioned that, there will be a trust-based regulatory discussion, to be able to build for the future.
Trust first, scrutiny later. That's what she advocated and said also.
No, what basically it is that, if you really want to grow to be the third largest economy, we need a 7-8% growth, like what you rightly said. And maybe whatever we do, that 5-6% will come. But it's that additional 2%, right, which is going to be, needed, especially when it comes to manufacturing and all the areas that you talked of, infrastructure. Today, the infrastructure actually also talking of a public-private partnership, right? I think that to me was a big takeaway, that the collaborative process by way of which one can build for the future, I think is very, very important, and that came out. Now, how well it gets implemented and how are we able to, actually take it to that level is something, that we will see. The second big point here is, the entire aspect of investing in people, economy and innovation, right? Because that is going to be a big driver, because eventually, it's the young people of this country that are going to, create a lot of change, a lot of skilling that came up for that, and deep tech, the 20,000 crore. But at the end of the day, if you go to see, the investment in those areas have to be much deeper for us, because Gen AI, for example, is impacting manufacturing. It's impacting every sector. Just a few days ago, we saw $600 billion market cap being wiped out in one day in one company.
True.
While we have allocated 10,000 crores and we're talking of 500 crores for a center of excellence in education, it's not enough. I mean, I don't think we realize the importance of what technology is going to play. So to me, whether we look at infrastructure, we look at manufacturing, we look at all the new age, businesses that India will create for the world, our focus around innovation and deepening that as India's strength could be one big differentiator as you move forward.
Mr. Puri, coming to you on the Capex side, the target which has been set for FY26 is quite moderated. Even in the FY25, they have kind of, reduced the estimates. So, what led to that, according to you?
So I think as far as the current year is concerned, I think there have been some transitory issues because of the elections and also some weather-related events, and that probably could have caused the moderation. And as far as the year ahead is concerned, so it's 11.2 lakh crores, which in an absolute number is a significant number. It's not a small number. If you go back several years and see what we used to invest, so it's a significant step. So let's acknowledge that. Of course, the aspiration for the industry was higher, but at the same time, let's acknowledge that 11.2 is a good number. I think the Honorable Finance Minister last year also made an observation that they will sustain the investment at a percentage of GDP. I haven't done the maths, but possibly that's how it is getting aligned, because it represents the rate of nominal growth of GDP, the increase that's happened. So it's a good number. We would, of course, like to see it better. But if we sustain it at this way also consistently over 2 decades and beyond, I think it'll have profound impact on the economy.
But somewhere they tries to maintain the fiscal glide path as well at 4.4% for FY26. So you think it's a kind of balancing act which FM tries it?
Yeah, budgets will always have to balance the books. I think that's, and we must compliment the Honorable Finance Minister for doing it admirably well in a very difficult situation. I don't think any finance minister has faced such difficult situation to balance the books, COVID, and therefore, and really adhering to fiscal glide path. And if we get into the details of the budget also, the very clear intent stated that 1% reduction into debt by GDP every year, and getting to about 50% by 2031. I think that's a very strong position that's going to reduce the cost of borrowing and sovereign ratings, etc. So fiscal prudence, I think, is something that this government has done extremely well, and that's why that's why the macros of this economy are strong, and that's why India is progressing well, where a lot of other places are actually struggling.
But with the growth estimation now, it's not cautiously optimistic government. Even in the survey also, we have seen the target range is between 6.3 and 6.8. But do you think that external headwinds, which survey also talked about, you think that we are in that path and these measures will help government to sort of achieve 7% GDP growth? In the next fiscal?
Yeah, I think despite all of the headwinds, we are achieving this, right? And I think, it is going to be a future, at least the next year, with a new administration in the United States, threatening tariffs, looking at export, so many changes that might happen, in an uncertain world. I think some core measures that we have hedged up already, whether it's our oil imports and others, we've made sure that India will continue to have this base level of growth.
True.
I think it's that incremental, 0.5% which we were talking of, where, I think it is actually making Indian industry also probably a little more courageous, more risk-taking on the back of, government, investment in Capex. And I think the private sector, new age sector, new industries can actually, bring that difference. Yeah. Also, I feel at the end of the day, the consumption, which will increase probably with these tax things and, kind of giving direction to people, will eventually in some way, create a upward spiral. India is a country where we're going to continue to see income levels rise now for the next 20 years. And we have people at all levels, right? How are they spending? What are they going to invest in to create more wealth, to create more, addition to the GDP is going to be a very exciting time. So I think we need to get that virtuous cycle going, at which point we will probably be able to, qualify that the 7.5% is sustainable for the next 20 years.
Yeah, sustaining the momentum actually. And in fact, a lot of focus I've seen on the compliance part, ease of doing business. Even survey talked about, deregulation. How you think that budget that try to address that as far as, business output is concerned and easing the compliance?
I think the business has I think businesses or industry would be very pleased with the announcements that are made in the budget. There are some areas like in the tax where there is a direct announcement of a lot of rationalization and simplifications, and including providing safe harbor, providing certainties and so on and so forth. I think that's very, very welcome. Besides that, at a larger national level, at the level of the economy also, there are very strong statements there on collaborating with states, incentivizing states on reform, also setting up a high-level committee to really create the blueprint for the or the new architecture for regulations in India. I think that's a very visionary way to do it. It'll set the whole blueprint, and then hopefully the implementation also will get better once we have a full view of it. And the feedback from the industry, from members of CII, is very clear that these ease of doing businesses can really, and cost of doing business can really unlock a potential in many sectors.
Quickly, Mr. Puri, how you see the two decisions on the taxation front? One is, of course, the personal income tax, where the rate is now no tax, literally up to income 12 lakh, and plus the new income tax bill is going to happen next week, is what FM indicated. How you sort of seeing these decisions, and this is going to impact the taxpayer overall?
So both are positive steps. The first one is going to provide relief to middle class, and which is much needed at this time, given that consumption also is soft. And I hope coming forth this month itself, the monetary policy will ease interest rates so that the EMI stress also is reduced. And better consumption, besides leading to revenue buoyancy, which also ultimately leads to investment in jobs and contributes to creating a virtuous cycle. So that is so very important. And the new income tax bill, as we understand, is aimed at simplification, rationalization. I think this is very much needed for enterprises. It's very much needed for individuals. So it's certainly a very positive step forward.
A lot of emphasis we have seen, on the TDS part, TCS part as well. Liberalized scheme has been now 7 lakh to now 10 lakh. So how you seeing these decisions in terms of, businesses? Will that help also? My question on the private Capex as well. Do you think that the measures which have been taken by the government, today in the budget, does that reflect in the private Capex? Maybe next fiscal?
So, your first point, I think it's definitely indicative of a simplification, right? Like as Sanjiv was saying, it's about simplifying, about, really not having a burden at a particular value, even though it is notional, increasing for a senior citizen, by a 50,000, it gives a perception that we are moving in the right direction.
Correct.
As I said earlier, this is a directional budget. Tomorrow the 12 lakh can become 15 lakhs, or it can continue to move in a direction as we as a country grow wealthier, as our people get more productive, and I think it's a whole journey, right? So I see TCS, TDS, where it is not needed, or where the simplification needs to come, easing out, at a particular level is indicative of our growth even as an economy. So I think those are very good steps that, got announced and sets again the direction right. To the fact that private, Capex will increase, eventually we do live in a market-led economy, right? And I think at the end of the day, business will be competitive. We will have to, see that there is enough demand that is getting generated, even to get private, sector at scale to invest and to become more courageous as you go global. And this is going to require many things to happen. I think boosting a little bit of consumer thing has shown that will increase, at least some part of the Capex. But I think a larger part will be our global competitiveness. And if we look at, ease of doing business, we look at, the cost of funds, how does India really, participate at a global level? How do we as a country, leverage this tight trust-based relationship with government to put India out there, a lot more, is something that we need to think about as a country together.
Yeah.
And I think all of these are steps in the right direction, to be able to build that ecosystem. So that at one tipping point, I think that, thing will happen. Now, whether that happens in a year or 2 years, or, a little longer, but I think the journey is definitely directionally very right.
Rightly said. On the globally, global front, they are talking about that there should be, some exemption were given in the custom duty, and in fact, there are a lot of decision taken in terms of manufacturing side of it. Also, decision taken in terms of how to rationalize custom duty in many sort of products. Do you think that this will bring value addition, and this will sort of boost export as well? Also, your word on the private Capex. You think that all the measures have taken is sufficient to drive private Capex?
Okay, coming to the first question around the rationalization of customs duty, I think that's very much required to enhance the competitiveness of our exports. And this is something that CI has been recommending also ultimately
Yes.
to move to a 3-tier customs duty. I think what is also very welcome is what I said earlier as far as exports is concerned, to take a sectoral approach and create an interministerial group. Because from a global context, this tariff barriers are a challenge. The whole globalization trend is taking a back seat. So we do need to have agile responses. We do need to sign more FTAs, that's the way to go. We do need to invest in the domestic drivers of competitiveness. And we also need to deal with the issue of excess capacities in certain geographies where stocks are being dumped in the world and also in India, that reduces opportunity for Indian industry. So a coordinated approach there is very much required. Now, coming to the second one is that private capex. See, first of all, let me say, economic transformation is a journey. It's not a button where you put it on and off and suddenly it's a process. And in the process, I think we have made much progress. In 22-23, private capex as a percentage of GDP exceeded the pre-COVID numbers. After that, private capex has been happening. We don't have full year figures for 23-24. But yeah, in between, I think during the certain transitory period, there was a little slack. But if we look at CMIE database, in Q2 and Q3, they have been encouraging announcements. If you look at the order books of industries that provide capital goods, that is that the order books are full. If you look at the CII surveys, where, about a third said this year that they will increase capex spending in second half, and about 45% are saying in the next year they will increase capex expenditure. So very clearly, I think we're all set for more and more private capex. What was really required also was to touch upon sectors that may not have such heavy capital expenditure, but they will be heavy on employment generation, which is the labor-intensive sectors, which have been touched upon. So, and the headwinds to this, capital expenditure were really the softness in consumption, sticky food inflation, interest rates, liquidity, and also the dumping of goods globally and the soft demand globally. So dumping we can deal with. Soft demand is not for us to deal with. I think interest rates hopefully will do. Liquidity is already, the RBI is already working on it. I think the focused approach on agriculture should help also deal with the issue of sticky food inflation. There's a specific focus on, fruits and the horticulture piece of it. So I think fundamentally all these are drivers that will continue and enable the building of, the journey towards more and more capex and the journey towards Vikshit Bharat.
Also, corporate India is hopeful for the rate cut in the February monetary policy?
Absolutely. I think, see, if you look at inflation, we are managing it better than the rest of the world. The only element in inflation that is high is food prices. And food inflation is not really related to money supply or interest rates. It is more a supply side issue of climate change. And therefore monetary policy cannot really do much about it. And we are in fact suggesting that in the, the monetary framework, this should be delinked. And there is all the reason right now, I think, for the rate cut to happen in February.
Clearly, all the reasons for RBI to consider rate cut. Thank you, gentlemen, for taking out time for us. Thank you so much.
Thank you.
Hello and welcome. We are, talking all about the budget now because slew of provisions, lots of changes, and we have with us Mrs. Vibha Padalkar to talk to us, Managing Director, HDFC Life, to talk to us about the changes in the life insurance sector. First off, ma'am, this huge migration that's likely to happen from old tax regime to new tax regime as a result of the slab changes that have happened in the new tax regime. And the benefits that are going to accrue are going to be large when it comes to the new tax regime, and therefore makes the old tax regime a bit redundant. I want to first talk industry. Does this impact the industry as a whole in your view? Because if it does, it will likely impact you as well in some form, but I'll come to that.
Short answer is no. I don't think it's going to significantly impact because of this reason. It's already well understood that almost 70% of taxpayers have already shifted to the new tax regime. That's data point number one. Despite that, the sector has grown fairly in a healthy manner, anything between, depending on which quarter you look at, anything between 15 to 25%. So the new normal is already within us, and yet insurance is moving away from a close correlation to tax or that being the catalyst to looking at many other aspects such as long-term protection, retirement protection, term protection, and so on. So that is point number one. Point number two is on this aspect specifically to HDFC Life, that despite 70 odd percent of overall at a country level having moved to new tax regime, at HDFC Life, looking at our data, only about on the outer limit, only about 2% of our employees could possibly have bought life insurance savings policies because of tax reasons. So it is not a material number at all.
Ma'am, would you have the metric for that at an industry level? So you're at 2% clearly.
Yeah.
But what,
Yeah.
what is it at an industry level?
Yeah, as a proxy, it's difficult to say. But if one's average ticket size is reasonably low, ours is say 1 lakh rupees average, all policies put together at a company level. Of course, if I back out term and so on, it will be slightly higher. But assume it's 1 lakh rupees, then that individual is unlikely to be buying this for the sake of tax. However, if one's average ticket size for savings is a lot lower, then there might be some correlation between reason for buying it being tax.
Okay. Ma'am, I'd switch focus from individual to FDI within the sector as a whole. There's been a relaxation now from 74% FDI up to 100% allowed. First off, I want to understand whether this is actually a positive or a negative for the industry as a whole, because does it not leave the window or the door open for competition to come in with 100% subsidiaries and start participating in the life insurance sector?
Yeah, hypothetically, what you're saying sounds logical, but let me deconstruct. When 26% went up to 74% in terms of FDI, in that window period for life insurance sector, only 3 companies took their share up to 74%. And I don't think any of the dynamics have significantly changed for the large player because of that happening. And that has happened quite a few years ago. That's point number one. Point number two is that the math is it would take anything between 2,500 to 3,000 crores of capital and possibly waiting for a decade before you even start seeing any return on the capital that you put in. That's the kind of gestation period in the life insurance sector. So not that many in terms of ability, to be such patient investors given all what's happening globally in terms of turmoil. Thirdly, even assuming if that comes in, India overall, if you were to look at penetration, very, very low. Actually, we have gone down. If you look at our regulator's annual report that has come out, the numbers show that actually penetration has moved southward. So really, we are looking at the tip of the iceberg rather than really quibbling over who's to get what. I think there's a huge opportunity in any case. So I think that any tectonic disruption happening because of this is limited. Because this is just an extension of 74 going up to 100, but actually the big ticket change was 26 going up to 74, and we hardly saw any new capital. Really, this is a red herring in terms of the capital limit being a showstopper. I think what could bring in a lot more capital is stability in terms of regulations and outlook for the sector. I think that's really what could change the fortunes in terms of money flow coming into our sector and really any sector. And we've had a disproportionate share in terms of some of the significant changes, all for the better, but nevertheless significant changes in a piecemeal fashion does spook investors because they don't know what business model to expect. And really they have to have faith in a developing country to say, it should yield returns, but that does require a very different kind of risk appetite.
So ma'am, talking about FDI, 100% FDI, I want to try and understand, therefore, what's the impact on the industry? You're suggesting it's going to be a very limited impact. Is that the right way to look at it?
I would be surprised that if it change the competitive intensity in any significant manner.
Okay.
If it increases penetration, great. But if the question is that is it going to significantly change competitive intensity in the near term, that's not my view.
Okay, fair point. Ma'am, the last point I'd like to cover is the other one big change with regard to Ulips. Just decode that tax for us, because Ulips are now included under Section 45 of the Income Tax Act, treating it as a capital asset. And of course, it's only selective Ulips above a certain threshold, and of course, with some terms and conditions. Just decode that for viewers.
Yeah, while I'm happy to decode, the government now has issued a clarification on this matter. But just to summarize it succinctly, hopefully, the change happened in February 21, wherein unit-linked policies about 2.5 lakhs of annual premium were taxable. So unlike before that, wherein everything was largely tax-free, this became taxable. Policies up to 2.5 lakhs of annual premium were tax-free. What now the clarifications say is that policies that were sold before February 21 that were not tax-free for various reasons, such as the multiple in terms of premium to sum assured, used to be taxed under marginal tax rate. Now they're going to be taxed under capital gains tax rate. So this is a significant positive for those policy holders, because say at the highest marginal tax rate of 30%, they would have paid tax at that rate. Now it's going to be at 12.5%. So this interpretation, unfortunately, was not the right one to say that there's a negative impact. There's actually a positive impact for those, and no change in terms of how unit-linked taxation has been since 2021.
Point taken, ma'am. Okay. And what component of your product would qualify under this category of ULIP?
It would be a very, very minuscule amount, because most of our policies have been have had 10x cover, and so really negligible number of policyholders. But yes, whoever had bought those policies back in time, they will benefit from it.
Okay, thank you so much, ma'am, again for coming in and speaking with us. It's a welcome clarification, of course. Stock has reacted, and hopefully this clarifies for both viewers as well as investors.
Thank you very much.